Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Sorry, Calvasina now with RBC Capital Markets with a mid-year briefing and forward. What's the Calvasina nuance right now? You've been wonderfully in the market. I don't get go to cash from you. But what's the nuance to stagger into September, or dare I say December?
So look, I think this is a complicated tape, Tom. And when I look at my models, you know, we err on the side of being intellectually honest, as we think all Wall Street people should be. But the reality,
it's an original idea for Bloomberg surveillance, but continue.
But the reality is when we've done sort of our typical valuation EPS type modeling, it tells us the market's a little bit over our skis. I even tried to put in some really, optimistic assumptions, take inflation down to 2%, raise earnings on a bottom-up basis from where they are for this year. I can get the math to 6,200, but if I just sort of use, baseline estimates on the street, the math is more like 57, 5,900. Now, if I look at it from a sentiment perspective, we had a growth scare on April 8th. We bottomed out 18.9%. How much does the market tend to run after those kinds of drawdowns? Where is it 9 months later? You can get to around 6,300 on the S&P. So we're obviously there. So the market has made sense to me from a sentiment rebound perspective. It hasn't made sense to me from a valuation fundamental perspective.
And it doesn't make sense on a fundamental basis, yet we're rolling right into earnings here starting next week here. So what do you need to see from corporate America? Well,
I'll tell you what, some of the questions are on my mind, and I kind of put it in the context of what I heard from investors. I took a day off last week, but the 2 weeks prior to that, I'm allowed every now and then.
Really?
Really. I put my weekly out early so I could take the weekend off. I know.
Well, the
Shocking.
II travel is now over. I've declared it over. These analysts, they travel in the spring aggressively
to get the trophy thing going.
Done. Yeah.
Yeah,
that's how it rolls.
But I was, a bunch of different states all over the place. Some of the marketing I did with my rate strategist, so, got into front of a fair number of, kind of multi-asset type people. And I'll tell you, everybody kind of wants to look through 2025. And a month and a half ago, it was, well, we paid the price for whatever potholes or whatever inflation is coming. And now it's really morphed into, there's not going to be any inflation. I actually had one client tell me tariffs are deflationary. And I have a lot of people who are looking at the recent cooler than expected prints and saying the tariffs aren't going to show up. Whereas when I talk to, my colleagues at RBC and we all kind of debate when those impacts are coming, we've thought it would be more in the fall all along.
Okay.
So we think there's a little bit of a mismatch. I'm hearing from investors, companies, they're very excited about CapEx. And then I see something like the Duke CFO survey, which came out, I think, 2 weeks ago, and really kind of threw cold water on the idea that all this CapEx is coming anytime soon. So those are things we're going to have to sort out in this reporting season. Are companies excited about the one big beautiful bill and the bonus depreciation? Are we, going to get a lot of kind of green shoots on CapEx? We're going to have to see. But I can tell you the equity investors I just got done talking to think it's coming and it's baked into the market.
The Royal Bank of Canada is definitive across the heritage of 19th century Canada, from the Maritimes and Nova Scotia down to which was then the financial capital, Montreal, Toronto, still under development. You people have a huge focus on the tariff wars. Brief us on what RBC says about what it means for Canada and what it means for the U.S.
Well, I just cover the U.S., so I'm gonna sort of stick to my knitting and not.
But tell us what the people in Toronto and Montreal think.
So, Tom, if I think
and Flin Flon.
if I think back to my most recent trip to Canada, seeing investors up there, it was a very different trip than what I had back in December and what I had back in February, when I would say we would go into meetings and the conversations were pretty much all about tariffs. When you talk to a lot of global investors in Canada who are always sort of thinking about countries and comparing them. And, we heard plenty of conversation about tariffs on this last trip, but there was also a lot of emphasis on AI and productivity in the U.S. And people were actually starting to talk about some non-tariff related things. And I know that sounds a little bit shocking. But I would say it was not as negative a vibe as what I had seen earlier in the year or late last year.
What screens well for you guys? I don't know if it's a particular sectors of the market or factors in the market, but what screens well for you? Because this market doesn't look cheap to me at all.
No, it doesn't. If you look at a cap-weighted, market cap-weighted S&P 500 PE, it's at 25 times again,
Wow.
which is getting close to kind of, the typical highs. You have a little bit more room to go back to past highs if you look at equal weighted S&P, and I think that's one of the reasons why we're started to see, kind of the momentum trade breaking down was kind of the big talk before my day off. That was the big talk on the trading floor about how the momentum trade was breaking down, and I do think it's because in part of that valuation differential. I would say, Paul, on sectors, one thing that screened well to us that we have actually upgraded recently, I understand it's getting hit pretty hard today, and I think some of that's on tariff angst, but the materials sector.
Okay.
We just did a survey of our analysts. We do this a few times a year. And my analysts in the materials space were pretty uniformly bullish across the board. My fertilizers analyst was neutral. That was the most cautious outlook I got. It's a very reasonably valued sector. We're starting to see earnings revisions improve. The dollar weakening should help that sector's earnings revision trends. And I would honestly, if we do get, some incremental sort of relief once we get past some of these, I guess the new August deadline on tariffs,
Right.
I'd rather play a sector like that than consumer discretionary, which actually hasn't underperformed since the Liberation
Right.
Day tariffs.
Lori, thank you so much with RBC Capital Markets.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's get right to it because it's a mystery, and we're going to be briefed as always wonderfully by Henrietta Treyz. She's the Veda Partners. We've been talking legislation. We've been talking the president's golf game, and now the complete confusion of tariffs. Henrietta, where is the outcome of this, the desired outcome of the Trump administration? Is it months out or years out?
We got 3.5 years of this, as far as I'm concerned. And the next 7 months are the most leeway that the president will have going into the midterm election cycle. And I think that's what we really need to focus on. So I think in retrospect, if we sit back here, next February, and we talk about where tariffs were today, I suspect that they'll be on the low end of the spectrum versus where they're going to be in the back half of 25.
What does it do?
Because
what does that, we're talking a tripling of tariffs, right? Or a fourpling?
Mm-hmm. Yeah,
what
minimum.
does that do to America? I don't think there's enough discussion about this, Henrietta.
There's absolutely not. And you can see it in the small business data. I was actually just looking at some of the polling. The small businesses are the ones that are most concerned, whether they're importing, couches for your outdoor stuff and selling it. None of that stuff is made in the United States. And so those small businesses are going out of business. And they're dealing with the steel inputs, and whether or not it's the component parts or just the big, pieces of rolled steel. It's everything that's getting tariffed now at 50%. And that's making the manufacturing sector drop off, employment there drop off. It is a sort of slow rolling train wreck. And the slow rolling part is, I think, the part that's most insidious, because the market has obviously adapted to it and is not reacting to tariffs the way that they did at the beginning of the year. And I think the slow burn of the way the administration is putting this on has the effect of tempering the market's expectation, like that frog in boiling water situation.
Henrietta, if I'm just any country out there, why don't I just kind of slow walk this thing? Because one could argue Donald Trump is a lame duck president, and every day he becomes more of a lame duck president. Is that a trading strategy for some of these countries, do you think?
I don't love that, to be honest, because a lame duck president can sometimes be the most dangerous. And especially now that the OBBB is done, there's no tether from Congress. I was talking to a client last week about how the Republican Party and the senators, specifically from farm states, were able to sort of temper the president's more aggressive actions on trade in 2017 when they were writing the tax bill. And then as soon as that tax bill was done, it was like a switch turned, and Ambassador Lighthizer just blew through the roof with Section 301 tariffs across all goods from China, on Section 232 tariffs for the first time. And that's basically the phase that we're at right now. The OBBB is done. We don't have to do a 2017 tax bill fix. We don't have to do any of the debt ceiling components for the next 2 years. We're really in free reign territory for tariffs, and I think that they are going up. Otherwise, why would you need an August 1 delay? The tariff rates are going up on hundreds of nations, or over 100 nations.
This is from a blog here, Daily 75. Thank you so much. This is Remy Cohen of Domain Caneros, which is a Napa Valley distributor. Not only do certain tariffs increase the cost of goods used to produce wines domestically, tariffs on imported wine also impact the domestic industry, distributors, retailers, and restaurants as well. When does this happen? Like when does the bottle, what did you have this weekend? You bought some outrageous
Barbaresco, sure.
It was Matus,
stellar.
or it was a Mogan David.
Drinking the Italians these days.
Henrietta, if Paul has his representative Mogan David 2020, how do they retaliate abroad? They're just going to tell the president no, right?
Well, first of all, Paul, please invite me next time. And then second of all, I think when you are looking into the details of the negotiations that are happening right now, to this point, there's a tremendous amount of focus on the Section 232 tariffs, the sectoral tariffs. So it's the wine industry, the pharmaceutical industry, semiconductors, aircraft, trucking. Those tariff rates and those sectors are inordinately exposed to higher tariff rates. And those 232s are permanent. So unlike IEEPA, which is where the base case of all these other tariffs come in, and they're at least subject to some sort of concern about whether the Supreme Court will let them stay on or the federal circuit courts, those 232 tariffs are permanent, and they're an integral infrastructural problem for individual sectors.
Next time, Henrietta Treyz on French cheeses and what it means there. Thank you so much with Veda Partners.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Our conversation of the day for American Wall Street. Sheila Kahyaoglu, Managing Director at Jeffries, is absolutely definitive on the broad transportation and aviation business with a real defense bias as well. Paul asked the money question when you walked in our beautiful, somebody said our studio looks like Get Smart's The Cone. You don't even know what the cone of silence is.
Sure I do. Yeah, absolutely.
It is the cone of silence. Unless Sheila's talking. Is Boeing back?
Boeing's doing better. It's on its way back. I think it's steady improvement, and that's what we really want to see. Kelly Ortberg has been CEO for about a year now.
What's he doing different now versus the other train wrecks?
I think he's more engaged versus Dave Calhoun, to be quite frank. He focuses on 6 KPIs. You have Stephanie Pope running the commercial business, and they're focusing on steady improvements. They're focused on what the workforce wants to see, what's user-friendly. I was down in Charleston in February. I've talked about this before. If the old school manual doesn't work and it's very, very aerospace heavy focused, then the workforce is now newer, less senior. Can we make it easier? What do people use today? They use YouTube videos on how to fix things, and better documentation. That was one thing that learned from the Air Alaska accident last year. So,
it's not funny, Paul, but a YouTube video, how to use a rivet gun.
Exactly. I don't know. Sheila, what I've been kind of led to believe is if you want to really get a sense of how Boeing's doing, track the 737 deliveries. Where are we today? And maybe where does the company want to get to?
Sure. The 37 is very important because the 3 things we look at for Boeing are 37, 777X, and defense. 777X is losing $4 billion this year, $3 billion last year, so quite a big number.
Ooh.
Like $4 billion of free cash flow losses. Defense is a $2 billion loss last year, $1 billion this year. So I like to keep an eye on those 2 negatives that people don't often focus on. 37 accounts for 50% of free cash flow. The way we simply put it is you're making about 10 to 20 million of free cash flow per plane. So last year they did an average of 24 deliveries a month. This year we thought they'd get to 30. They're trending June, which they'll report tomorrow at 11 a.m. at 42 maxes. So they're 10 higher than we thought. So think about that. Annualize it for the half of the year. That's about 500 to 750 of free cash flow.
Are they losing on the big planes because of Airbus? How do you respond to a given listener, viewer, congressperson who says Boeing can't compete with Airbus because Airbus is government supported across France and all of the continent, and Boeing is not government supported? How do you respond to that observation?
So, great question, Tom. Boeing actually does better on their wide bodies. Their wide bodies, they have about 60% market share versus the narrow bodies, they're at 40, so it's the inverse. The wide bodies they manufacture are the 787 really, and the 777X is new. We don't really, it's not certified yet. The engine by GE was certified in 2020. this aircraft was supposed to be certified 5 years ago. It's expected to be certified in 26. Right. So what Boeing's doing right now is building inventory. So they have 5 production test flight program aircraft in test flights. So they're building the planes to deliver in 26, 27.
Okay. Let's say they get the airplanes to the airlines. Do the airlines need them? Do they want them? Where are we? How are airlines doing?
I actually wrote a note about this on my way back from the Paris Air Show. I was flying.
How come the air shows are not in like Sheboygan? They're always in Paris or London.
Yeah, they're in great locations for a reason. Airspace is a great sector to cover, not only because it's neat, but we have great air show locations. Yes, I was on a 777, the older version, from Paris to JFK, and I looked up the age of the 777 fleet, and it's 14 years old, 14.3. Yeah. You know how many airlines in the U.S. and Europe have ordered 777Xs? About 0. So it's quite interesting that there's actually a big opportunity for 777X orders.
I got to get this in. I was on the deck this week and having a beverage of my choice. They go, Sheila's on the show Monday. They go, ask her about business jets. Business jets pollute under 2% of our air pollution, but everybody's having a total cow about the pollution of business jets.
I think it's 0.02% of all transportation pollution.
Does the Gulf Stream that we have a G3, but the business jets pollute.
I'm surprised you haven't upgraded to the G700.
We have a ticket in for that.
I said we have a ticket in, but Redo said no. We haven't upgraded, and for the height, it's a problem. But does the G3, does it pollute? Am I supposed to feel guilty when Lisa goes off to San Francisco on the G3?
0.05% of transportation pollution is what biz jets account for. There's just not a lot of them out there.
They're just going after the rich people, right?
Yeah, and they don't fly that often. I mean, think about airplanes. They fly some cars, trucks. I mean, it's just, I think aerospace is a rather...
Okay.
You're okay, Tom. Don't worry about it.
I'm looking at the
keep on flying, Tom.
Like what Taylor has, and I just can't make a decision. We're sticking with the G3. Sheila Kahyaoglu, thank you so much with Jeffries here today on Boeing and on the resurrection of Boeing.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Right now, briefing, Brad Rogoff joins us, Global Head of Research at Barclays here. And what's cool about Brad Rogoff is you've got not only the economics, but also actual nuance within derivative fixed income instruments, high yield, and such as well. Where is the opportunity forward? If you look at the broad spectrum of Barclays research, where's the key opportunity?
Key opportunity across all of markets, right? Give me a big playing field here. I appreciate it. So look, I think since we said global, right, I think we have to talk about that a little bit. And we've seen a real rally across Europe, across all sorts of products, right? Whether you're looking at fixed income, you're looking at equities, and we do think there's probably shifted to a little bit more value to the U.S. than we thought at the beginning of the year. We actually did prefer Europe in a lot of different areas. Then I think there's the U.S. and then there's certain opportunities within emerging markets as well, but we think, U.S. exceptionalism may not be as exceptional as it was if we go back a year ago.
Is our earnings exceptionalism going to be there quarter after quarter? Paul have the number memorized, and it's a beat, whether it's the top line, bottom line, whatever. Why is it going to change this time around?
No, I think if you look in the U.S. and you say, okay, earnings growth may be less than it was if we go back over the last couple of years, but still a lot better than if you look at data for where European companies are right now, where earnings growth is much more modest. So, it's exceptional relative exceptionalism, I guess, is maybe the term we should be using.
What is a non-bank financial institutions, and why should I care?
You should care because they are taking up a lot larger portion of the financial system at this point. So, a non-bank financial institution is not a bank, right? That's the easiest part about it, but one of the things you guys talk about here, we talk about in all of these programs, is something like private credit, for example. And we talk about how banks are being disintermediated, right? That's a very common term. And then we always talk about how the private credit markets are so opaque, right? Because they're being done at these non-bank financial institutions. Well, what you're seeing is a lot of the lending, like a traditional C&I lending that used to be done purely at banks, is actually happening at these non-bank financial institutions now. And it's really changing the customer-client type relationship. And it is leading to a bit more leverage in the system. So that's probably the answer to why you should care, is if that leverage gets a little bit excessive. And I don't think it's as opaque as most people do, but it's not as clear and obvious as when this lending occurs at banks.
So do you and your team, forget about you as global head of research, but do fancy Barclays people have an understanding of what the haircut is for people that need to exit private credit or private equity?
Yeah, sure. So if you think about it, there's two different ways I would think about it. First is if you just own private credit, right? You can put leverage on that. Think about business development companies, which is probably the thing the most familiar with people listening, right? Because anyone can go out and buy a BDC. Even those they can have up to 2 turns of leverage, but they have a turn of leverage essentially on it, right? So there's your haircut right there, like 50% haircut. But then what you're asking about is another thing, which is if you need liquidity as an endowment, as as any kind of institution, and you're willing to sell that, what's the haircut?
Right.
Go ahead, Tom.
I think, Paul, to me, this is the heart of the matter. I'm listening to Brad Rogoff, and it might as well be 2006 or 2008. I'm sorry, the same phrases are there as we heard years ago.
So I think that's a fair comment, right? And look, as someone who worked at Lehman Brothers then, I get it. I would say lived through it, but I guess we died through it at Lehman. But what I would say is, it's absolutely, there's leverage, there's more leverage, right? Which reminds you of pre-GFC. The difference is the quantum of that leverage. Look, I remember sitting there looking at very similar instruments being levered 8 times then that are levered 2 times now, right? So that's a difference. That's a difference.
There's less
but there's less of it, but there's leverage once again.
So how much risk, if any, do non-bank financial institutions, private credit broadly defined, how much risk is that in the system? You're suggesting that better capitalization, so the risk shouldn't be concerning? Is that the kind of
I don't think it should be nearly as concerning as the time period that we just referenced, because there's a lot less leverage. Now, what's happening is the loans to those companies, the underlying leverage, meaning the corporates, right, are still levered more than the lending that banks are doing. So there's a little bit more risk related to that, right? But this funding being more stable, obviously, is a positive thing, right? And I think the risk that unwinds lower, and also the assets that are being owned by private credit and non-bank financials and the leverage being provided on that, these are assets we know and can model. They're typically corporates. What we're starting to see, and another term you guys have probably used a little bit here, is ABFs, or asset-backed, funding, and and a lot of different nuanced asset-backed securities where we're seeing more and more leverage on that. That worries me a little bit as we move forward. We're not there yet, but if you start putting leverage on things you can't model as much and don't have history, who knows?
Barclays cheeky. Tim Long with an underweight on Apple. I mean, this is, it's not a lonely call, but it's controversial to say the least. From where you sit with all of your, I'm going to call it as a broad sense, derivative experience, Brad Rogoff's take on Mag 7 and its enduring stream of cash flows.
I think the enduring stream of cash flows is, look, I'm a fixed income guy. I love enduring streams of cash flows.
From a fixed income, folks, this is really important. Years ago when Amazon blew up, it was Lehman fixed income that was out front on that train wreck. You guys see things, they're twisted, Paul, I say. How do you look at Mag 7 coming from a clip the coupon side?
Look, from a credit standpoint, right, the beta on Mag 7 is vastly different than when you're thinking about the equity world, right? So these are some of the least levered companies. You see the cash they have. The problem with the cash they have and the cash flow that they throw off, though, is that they're spending it on something, right? Right now they're spending it mostly on data centers, right, and AI. And so, it depends whether you think they can turn that cash flow on or off, which I think they do have some flexibility around. But from the fixed income side, we worry a lot less about tech in general. But if you don't mind, I'm going to actually take it back to your last question too, which is what would be the concerns, right, that you were just asking around private credit? Well, the concerns would be that the private credit market is massively over-indexed towards technology. And if we think this AI revolution leads to, say, certain software companies being less relevant in the future, then that's actually a problem that could come from private credit.
Brad, real quick, how do you get paid for research these days? Is it harder and harder? Back in my day, there's many ways I could get paid for my research.
Yeah.
How about today? How do you guys think about that?
Yeah, well, look, as someone, once again, comes from the fixed income side, looks at the equity side now, those answers are very different, right? Yeah. On the equity side, I would say increasingly, and a really important part of it is the connections we have with companies, right? And you build those connections and you're making sure investors really get to know those companies. Putting on events and doing the right type of events are a huge part of it. Mm-hmm. And then, look, in the fixed income side, coming up with ideas, couldn't be more important. And I think that was probably always the case, and it still is.
Thank you, Brad Rogoff. Greatly appreciated. Global Head of Research at Barclays on fixed income.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Newspapers, Lisa Mateo here to brief. What do you got?
All right, I want to start with the Wall Street Journal because they're talking about pricey mountain towns. When you think, who do you think of? Like Aspen? Do you think of Telluride?
Gura put in a down payment out of Telluride.
Telluride, there you go. That's another
two-bedroom
one.
house, $4 million.
There you go. But there was a new place catching up. It is Ketchum, Idaho.
Oh, yeah.
And you say, who? Well, it's a former mining town. I didn't know this. South Central Idaho, Sun Valley, main tourist area. Realtor.com says in May 2025, they had a medium home listing price of $3.72 million. Mm-hmm. So it has a small downtown, about 6 blocks, restaurants, galleries, bars, things like that. But it's nice. It's near great skiing places. So that's one of the reasons for the draw. They have a couple things, at the end of just summer, they have their wagon days, big hitch parade. They have
I've never been.
Trailing the
awesome.
sheep
Yeah,
parade.
the Allen and Company media conference is there.
Yeah, Ed Ludlow's going
in July.
this year.
Yeah,
Correct.
this week.
Ed Ludlow,
yes.
Ed Ludlow will be there, and he's looking. He's like 4 streets out from the center. He's looking.
Yep, and I love Sun Valley. I've skied there a couple times. It's not a monstrous place like Vail, but it's outstanding. Really good. Love it. Great
So
weather.
do you see it in comparison to an Aspen or a Telluride?
Way smaller.
It's smaller. Yeah, it's smaller, but it's as high quality as those. And the downtown is fantastic. So it's great.
It says Ed Ludlow.
Yeah.
Next.
Okay. A big day tomorrow, Amazon Prime Day. Okay, it's kicking off.
Did not know that.
4
Thank
days
you.
this
Yeah, so it's
time.
not a day, it's 4 days.
No, it's 4 days. They increased
Is it for real? You can save money.
You can save money on certain items. So that's the thing. You have to go and see what are the big deals. Bloomberg Intelligence says it's going to be a big thing for them because they're offering the big discounts. People are kind of scared about tariff-related costs, so they might be a draw to this. There's a lot of AI-powered tools that are going to make it easier for people to shop. But what Amazon banks on is that more people will sign up for their subscription to the Amazon Prime.
Okay, but Costco does this 24/7. What's special about this versus what you're living in aisle 6 at Costco every
These
weekend?
are like deep discounts. Like these are bigger than Costco discounts. But I mean, you compare the Amazon Prime membership that you have to buy in order to be a part of this versus the Costco
Is this like
membership.
Bentonville, Paul, and that the savings, if you will, is all eaten by the manufacturer, the people that produce the item?
Exactly. And I think this Amazon, just putting it at this time of the year, which is usually a slow time of the year, just juices up sales.
Yeah.
So,
and I
there
think
you
just
go.
the fast delivery. I mean, you can get
Yes.
it tomorrow or even the same day.
Where you guys live, folks, we don't talk when we're not in the show. I mean, Lisa and I, she hates me, but it's a separate story. Where you live, is Amazon just like ubiquitous?
Yes.
Where I live, they're everywhere.
Yeah.
Every corner, 24/7.
Yep, absolutely.
Everywhere.
And you go out on an interstate highway, and there's more Amazon trucks than anything else out there.
Than
Quick, one
FedEx
more.
or anything.
One
like
more.
that.
I know you worked
Okay, so a new study saying that sweet and salty treats, they're being left on the store shelves. So people are not having them, like the cookies, the potato chips, the chocolate bars.
Yeah,
more
it's
people
huge
are-
And
deal.
it's affecting like companies like Pepsi, like General Mills, all these
Do you
companies.
see a sea change here?
I do. Actually, we had like a big barbecue, and you notice people going less for the sweets. People also eating less because of the GLP-1s, that they're on. I don't know if it wasn't my cooking.
That
I
was
swear.
not my problem this weekend.
You didn't do that.
No, Nathan's Famous did it. It was so nice. George Say over there mentioned John Farrow and me at the hot dog eating contest.
Oh gosh.
I got up to 20 hot dogs. I
Oh,
couldn't
gosh.
go further.
So Joey, the guy came back. He won, right?
Joey,
Yeah, he
did he
won.
win?
Yes, yes.
He did. Okay.
Yes, he won.
Oh my gosh.
Have you ever had a Nathan's hot dog, Lisa?
Yes, they're delicious. We had them this weekend.
Oh, she's a Brooklyn gal, of course.
Yes.
Okay.
Gotta do it.
She's eating hot dogs.
I know.
That's the biggest news item this
Yes.
morning. Lisa Mateo in the newspapers.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.